Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Hey, for all the turbulence that has shaken the U.S. presidential contest this summer, voters have been consistent in saying that economy is their top election issue, but the economy that matters most is not national. This is important. It's in the 7 swing states poised to decide the race. We talk about the swing states a lot, Matt.
But we don't talk about this a lot. To me, this was pretty much new information.
It explains kind of so much.
And the way that these guys broke it down, I think, was unbelievably helpful. Like, they should work for the campaign.
Hint, hint. All right. This is today's Bloomberg Big Take, which is a story that our editorial team has deemed a must-read. It is among our most read stories on the Bloomberg. It's by a handful of reporters, including Bloomberg News senior economics writer Shawn Donnan in our Washington, D.C. bureau. And then right here in our studio, we've got Stuart Paul, Bloomberg Economics U.S. economist. Great to have you here with us both. As Matt said, a great story. Makes, I think, a lot makes sense in terms of the concerns among U.S. voters. Shawn, laid out for us what you guys set out to do and how you did it.
Yeah, look, our goal here was understanding, what was happening in the economy in swing states. As you said there, poll after poll shows voters nominating the economy as their top issue. We also know that voters in the 7 swing states are the ones that are really going to decide this election in November in all likelihood. And so we wanted to know the economy that they lived in. And what we found was some pretty, to me, was surprising new information. The first of which was just, we think of these 7 swing states as a kind of disparate family. Sometimes they're thought of being at the fringe of American politics or the American economy. But when you put them all together, it's 61 million people who live in a $4.4 trillion economy that would be the world's 4th largest and is up there with Germany and Japan in terms of scale. The second thing that we found that is also really important to think about is that economy is one that's been growing more slowly out of the pandemic recession than the rest of the United States. In fact, it grew at 2/3 the rate of the rest of the U.S.
Yep. Yeah. To me, the headline is, if you look at the economies in the swing states, the results are no bueno for the Democrats. Just because, Harris is going to pick up Biden's legacy, and these states have not only grown at a slower pace than the rest of America, but if you break it down by counties, most of the people live in counties that have done worse than even the state. Like, I look at Erie, which you headline or you point out in the story has seen a GDP per capita drop between 2019 and 2022, and everybody's just like moving out of there. But if you look at the counties across Pennsylvania, 40% of the people live in counties where GDP has fallen. So, Stuart, it's going to be hard for Harris and for the Dems to spin this.
It is. So much of politics is local, so much of investment is local, so much of infrastructure spending is local. And when you look even at the places where there's been a lot of investment in manufacturing, some of the stories are so unique and specific. So one of the major swing states where we've seen growth in manufacturing is Nevada, but a lot of that is really just a very specific story about manufacturing of Tesla's batteries. And so how much that resonates with voters who are experiencing a dramatic surge in the cost of housing, for example, and Shawn has done some amazing reporting around the cost of housing, it's difficult to see those sort of economic developments resonating positively with voters, at least as it pertains to Harris on the ticket.
I got to say, Shawn, one of the stats, and when you talk about Nevada, this particular county said, you guys include this stat, in 2019, a typical household in Nevada could expect to spend almost 20% of its income on mortgage payments if they purchased a median-priced home. That rose to almost 37% last year, according to calculations by Bloomberg Economics. I mean, how do you survive? How do you live?
Welcome to New York, Nevada.
Well, right. But I mean, this is a story we keep telling over and over here at Bloomberg.
Yeah, no, absolutely. And housing costs are, we talk about inflation a lot and the impact on consumers, but housing costs, which are related to interest rates as well as the value of properties, starter homes now are going for just, an incredible multiple of what they used to. And that is true in a place like Nevada. I mean, Reno, Nevada, where I was, was one of these places that is a kind of hopeful story about new manufacturing and economic transformation. The local economy there in Washoe County, where it sits, has been growing in population. A lot of people moving there from California and so on. But housing prices have gone through the roof, and that has started to dislocate a lot of people there locally. So, I spent some time at Catholic Charities talking to the folks who work there and work with people who are struggling to make rent. And one of the things she says is, what they're seeing is not just people who are homeless. What they're seeing, people who have good jobs and well-paid jobs, $25 an hour jobs, who can't afford to make rent because rents have been going up so much.
So the Nevada story is one of inflation that they're going to blame on Biden. Erie County is one on an exodus of manufacturing that they're going to blame on Biden. You get to Fuller County. I thought this was fascinating. In Georgia, they've seen per capita GDP increase 16% from 19 to 22. Population's up 14%, but they hate Democrats so much that they pretend the economy sucks. Like, how do you explain that away, Stuart?
It's difficult. So when you have a surge in population, you try to get those folks integrated into the economy as quickly as possible so that they can be productive, they can generate a lot of economic growth. But when the nominal growth that you've seen is about the same as the population growth that you've seen, you don't realize any improvement in your standard of living at all. And that's basically the story of what's going on. And frankly, it's a sad story. You want people to get integrated into the economy. You want standards of living to improve. And they're just not going to be feeling it, despite the fact that they've seen this influx of people that should help to buoy growth.
I want to go back to you, Shawn, in a moment, but Shawn is a master at doing these kinds of stories, taking us, to the granular level, the ground level, in terms of telling us what's going on across the United States, really getting to real stories. Stuart, working on this story with the team and with Shawn, as an economist, we often talk, government numbers, big numbers, and so on and so forth. What did you kind of find out?
What really gets interesting is when you do the head-to-head comparisons for Trump and Biden so far in this administration. Vice President Harris is going to be painted with the same brush as President Biden, especially if she wants to take credit for any sort of the employment growth and the low unemployment, generally low unemployment, that they've seen during this administration. It's really a story of the cumulative inflation and comparing cumulative inflation across the swing states, across the presidencies. If you look, there's only one swing state that's had lower inflation than the U.S. as a whole. 6 of the 7 swing states have seen the same or more inflation than the rest of the country. And to look at Wisconsin, where they've had lower inflation than the rest of the country, it's really a story of an economy that's in decline at the state level more broadly. You look at the rest of the swing states, Arizona, Nevada, where they've seen dramatic inflation, and that's way worse than the rest of the country, you would imagine that that's going to be a problem for Vice President Harris. And if you just zoom out to the national level and you think cumulative inflation under Biden's going to end up being about 22% during his 4-year term in office, people are going to remember that during Trump's time in office, there was just cumulative inflation of about 8%. And that's the thing that matters most. It's literally a pocketbook issue. How much is the money in your pocketbook going to buy you?
So they think they would be better off with Trump because you didn't have the sort of post-COVID inflation during his presidency. Shawn, what can the Harris Walz campaign do? Like, can they cancel their student debt? Can they buy them beer? Like, what can they do to get these voters back?
So one of the really fascinating things, in particular this week, as Vice President Harris and Tim Walz have been touring swing states, is to listen how the economic message has changed, right? She is much more about what is happening to households and promising a better future. She's promising to bring down prices. She's talking about corporate price gouging. Those are her words. She is trying to offer hope for the future. Whereas when President Biden was touring and campaigning, the message you heard was much more about, look, the American economy is the envy of the world. It's had an incredible recovery from the pandemic recession. I hear this all the time when I go to the G7 and so on. And that was a message that just did not resonate with voters. And we saw it in poll after poll. And so we're seeing the Democrats adjust on the fly. But, look, the broad point here is also that there is a disparity between what economists and markets look at, and those are the big national numbers in terms of the economy, and the local numbers. And it's the local numbers that matter in politics and continue to matter. We learned that in 2016, both here in the US, when we saw the election of Donald Trump and people started talking about those left behind places in America. We saw it in the UK when we saw Brexit in 2016.
Right.
We got to remember that lesson here in 2024.
Really important. Explains so much, certainly in terms of some of the voter dissatisfaction that's out there. Hey guys, thank you. Incredible read. Bloomberg News senior economics writer Shawn Donnan, Stuart Paul, Bloomberg Economics U.S. economist. Check out and you can read more of the Bloomberg Big Take. It's on the Bloomberg terminal and at bloomberg.com/Big Take.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We talked about this a lot during open interest this morning on Bloomberg Television about shares of TSMC. They were out of the gate, they were up about 1%, up 2% at their highs, but it did seem like their pre-market, they were going to rally even more.
Right, and that's because their revenue in July was up, 45%?
45%, yeah, so, exactly.
They were doing well, and this is a foundry that's key to the AI arms race, right? Because not everybody realizes Nvidia doesn't make its own chips.
No.
They send the plans to Taiwan Semiconductor, and Taiwan Semiconductor makes those chips.
Right, they're a contract chip maker, correct?
Yeah.
All right, so let's get to it. And I am curious, though, what Ian King has to say about what we did get from TSMC overnight. Ian, of course, Bloomberg News, U.S. Semiconductor and Networking reporter, back with us in our San Francisco bureau. Hey, Ian, good to wrap up the week with you. What we got from TSMC, it looked like pretty tremendous growth. What does it tell us about the outlook? And I always think about, so if it's good for TSMC, does it mean everybody or a lot of the semi space is doing okay?
Yeah, I mean, the monthly reports are obviously a fairly general number. We don't get the drill down that would give us more insight. I think the way it's been taken, though, there are a couple of things to point out. As Matt said, 45%, that's not bad. But up from last year where things were relatively weak, particularly the smartphone market, and you've got to remember that Qualcomm and Apple are really big customers of TSMC. But the other way to look at it is, I think you've pointed to, which is everybody is very nervous about this massive spend that we've seen on AI infrastructure. Will the big spenders keep going? And will the beneficiaries, notably Nvidia, continue to keep benefiting? And this number would appear to be a positive sign for that particular concern.
I wondered when I was looking at this and thinking about it, you focus on this all the time, but for me it's just cursory every 10 minutes every hour. They make all of their chips in Taiwan. Like if something bad were to happen between China and Taiwan, would the world be stuck with no more semiconductor production?
So you're right, all roads lead to Hsinchu. This company is tremendously important and now accounts for a large percentage of the world's most advanced semiconductors are produced in a couple of sites it has in Taiwan, but it also has a plant that it's bringing up in Japan. It also has one that it's building near Phoenix. So there is an effort to diversify, that supply chain. Also Samsung, the South Korean manufacturer, it's kind of nearest rival. So that has advanced capacity in South Korea, and they're also building, another plant near Austin in Texas. And then Intel is trying to get back in the game. So it would be a disaster. It would have significant consequences on the world economy, but there are efforts to diversify that risk.
I spoke with bankers, Carol and I both, with bankers from Ohio yesterday, and Intel is investing planning to invest tens of billions of dollars to build a factory there, but they have been teetering lately. In fact, Intel, I think the second biggest loser on the S&P today. Is it set in stone, or is it possible that they may not be able to go forward with all of their foundry building plans?
I mean, our colleague Mackenzie Hawkins did a kind of a good roundup of the CHIPS Act funding efforts so far. And, the key part of this, and I think the thing that we should all pay attention to, and particularly as taxpayers in the US, is the way this has been structured is you don't get money unless you actually do what you said you're going to do. So, yeah, you can throw up a building and we'll give you a certain amount of support for that. But at the same time, if you don't put the much more important equipment in that building and actually start sort of producing chips, then you don't get the rest of that money. So, government support is contingent upon a knowledge of the way that the chip industry has always worked, which is, hey, we'll build these shells and we'll hope that we get the demand, but then we'll only really put the expensive equipment in there if we're absolutely sure that we need to go ahead with expanding capacity.
I just wanted to ask because last night after you and I left this studio, Moody's downgraded Intel's senior unsecured debt rating to BBB from AAA, and Moody's said the downgrading reflects our expectations of Intel's significantly weaker profit over the next 12 to 18 months, resulting from a combination of higher costs related to product manufacturing, process technology transitions, unfavorable product mix, weaker than expected demand in nearly all of its product segments, and continued market share losses.
It's not good. Well, and I feel like, Ian, come on in on this, because I also feel like when they were, came out, they talked about in their press release, which it struck us all weird, where they were talking, I felt like, was it liquidity and cash flow, concerns? It just isn't something you expect from an Intel.
I mean, this time a week ago, we were kind of bracing for impact, and that impact landed, and it landed more heavily than I think even the most pessimistic people out there. Some analysts like Stacey Rasgon from Bernstein said, look, if Intel wasn't getting government money, if it wasn't getting outside financing, this would be a going concern consideration. And this is absolutely astounding for a company of this nature.
Unbelievable.
Doesn't it, like, you think about how, you've covered this space a long time. Like, to be talking about that is pretty wild, right?
I mean, I was looking at the numbers before I came here to talk to you guys. It's going to be less than half the size of Nvidia in terms of revenue. AMD, a company that struggled to even get on the map for years, is now up to over 50% of Intel's revenue. So that top line, that really important amount of money that was flowing in, that fired up all of this R&D, all of this building of new plants, it's just nowhere near where it used to be. Profitability has gone away. The cash flow is obviously struggling. They're not paying a dividend anymore. I mean, all of these things are not good signs. Their answer to this is like, look, we're taking the pain up front. We're investing heavily. We're paying for the mistakes of the past. But don't worry, we're on the way back. I think what the market wants to see now is evidence that points to that being absolutely the case. They want to see a bottom. They want to see a turning point. We don't really have any numbers that would indicate that that's the case at this particular moment.
Just so we don't end on such a dour note, I woke up this morning to read Carmen Reineke's story. Nvidia has lost almost $1 trillion of market cap in the last couple of weeks, which is nuts. But
still up 112% this year.
Well, that is
true.
Saying. And I was also going to say, there's still a ton of investment in AI. Like, the story hasn't changed because the Bank of Japan raised rates and the non-farm payrolls number came in low, right?
Absolutely not. We have had no evidence from this earnings season in particular that there's any slowing in the sort of wild rush to put all of this infrastructure in place. And obviously, NVIDIA is the main beneficiary of that. So we'll find out later this month what NVIDIA has to say themselves. But at the moment, there's no reason to be concerned about the fundamentals. The valuation of Nvidia, that's another story, right? That's up to investors to put the appropriate value on it. But the fundamentals at this point appear to be solid.
Pretty wild space, though. Ian, thank you so much. Really super, and always appreciate what he has to say. Ian King, he is U.S. Semiconductor networking reporter. Ian, have a great weekend. Of course, here at Bloomberg News, out there in our San Francisco bureau. It is kind of fascinating,
It is.
right?
I mean, there are times.
changes
I started out
just
as a
year.
cub reporter like 25 years ago, covering Infineon in Munich, and I thought, what a boring space this is.
Not boring
And
at all.
it is not boring at all.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, interesting trade today for shares of Pagaya Technologies. Shares soared as much as 19% in the pre-market before we got going. They've bounced around in the regular trade. They're down 10% at their lows, up nearly 8% at their highs. The financial technology company gave a quarterly outlook this morning, raised its full-year outlook, and also announced a forward flow deal for up to $1 billion of loans with Castle Lake. We want to get into that. Shares of the $1 billion market cap company are down about 14% year to date. Joining us right now is the co-founder and CEO of the company. He is Miguel Krubiner. He is here in our Bloomberg Interactive Broker studio. I'm not saying it right. You say it.
I said Gal Krubiner.
Yes.
But you can say it, yeah.
But that was very good.
Well, thank you very much. Hey, you have a fascinating business that you work with lenders like U.S. Bank, and that's not the fascinating part. Klarna is what is fascinating to me because you help sort of you help these buy now, pay later, this really popular new system to thrive. Tell us how you do it. What's the relationship, the partnership look like?
Perfect. So maybe let's take a step back and let's describe Pagaya in a second. So Pagaya is a fintech company that is helping lenders, exactly as you said, the US banks, the LA Bank, and up until the Klarna and actually SoFi too, that I'm sure you're familiar with.
Yes, of course, SoFi, yeah.
And we are using artificial intelligence in order to help them to approve many more customers. Now, with these lenders, through these lenders, we have already provided over $21 billion of loans, and we served over 2 million customers. And the way it works is very simple. Someone is coming to one of these services to ask for a loan, and for some whatever reason, the first provider could not provide the loan. We are getting all the information of the customer at that point, and for many of them that are actually very good consumers, we are providing with our technology the ability to extend the loan.
Even with the Klarna? So if I
Even
go and
with the
buy
Klarna.
something, say on RalphLauren.com, and it's $100, I say I can make 4 payments of $25 each. They shop that to another lender who says no, and then they come to you and you say, we can make it happen.
So what's happening is like Klarna is looking if they could provide that credit, and for whatever reason they can't. They're saying, hey, Pagaya, what about you? And we're looking into that, and we say, you know what? That customer is actually a very strong customer. We should definitely give him the loan. And then we are providing him the loan.
But wait, why does the first lender say no then?
Because there are very different ways that banks looking on things. They have a different regulatory regime. So for example, the FICO cutout, which is a very important to the way of how it sits on their balance sheet,
The FICO score.
could be very limiting factor for their ability to lend. Now, because we are doing it together with capital markets, and we have very big institutional investors behind us that are a little bit less relevant for that regulatory regime, so they have the ability to actually approve even if the FICO, let's assume, is below 720. So we are filling a very important gap in the United States ecosystem today, where banks, for regulatory pressure, needing to cut their lending for different type of borrowers. And then we are coming in and filling that in with the power of AI.
So who takes the loan on their balance sheet?
So the balance sheet piece is the very interesting piece. We have behind us 116 funding partners that has been funding these loans for the past 7 years. And they are utilizing our technology, or the vetting that Pagaya technology is doing for these customers, but they are the one who are providing the capital at the end.
Are these loans getting cut up into kind of like tranches, if you will, and different risk levels so that no one financial, whether it's Visa, whether it's SoFi, whether it's Ally, it has the exposure of maybe the riskier part of the portfolio?
So there is a pools that are being aggregated in between the different loans that we are originating through SoFi, through Lending Club, through US Bank, Klarna, and all the names we just described. And then an investor, when they just want to get, an exposure to the consumer credit in the United States. Mm-hmm. And then they're buying that pool of loans with the different type of loans from the different type of lenders, but all of that being priced by the Pagaya technology.
So you use the technology on that end.
Correct. So the way the loans are being priced is being governed by technology, and that's the AI piece that has created in Pagaya, but being embedded in each and every part of the different lenders we work with.
So you basically help filter through the people who are looking for, the consumer who's looking for different loans, right? And then it gets kind of...
Correct.
But you use the AI to do the pricing. So who wrote the technology?
So the technology has been developed in Pagaya. It's proprietary technology. It's one of the things we are the most proud of.
Does Pagaya mean something?
So Pagaya actually in Portuguese means to pay.
Thank you.
So definitely there are things behind that, Pagaya. But the interesting piece about the technology is that we have developed that, like over 250 very smart engineers that are working day in, day out, only about trying to get the best algorithm to be able to predict the behavior of someone to be able to pay. And the beauty of it, allow me another second, is that let's assume that these people are actually the ones who are being rejected from the bank, as we had in that conversation in the beginning.
Right.
But the reality is that their performance is not worse. It's actually sometimes better.
What do you mean? Whose performance?
The performance of the payers.
So that's what I was going to ask you. Do you have any statistics on default rates?
So the statistics on the default rates is that, like, what we have been seeing in the last year or more or less, since the really heavy inflation started to reduce, is that people are paying back their debt. And when we are looking on the delinquencies that are now versus what it used to be a year or 2 years ago, it's down 50% in their peaks. So it means two things. Number one, the technology is working and working well. And number two, it means that although we see some softening, and we saw that in many earnings on Airbnb and others, that the consumer is starting to spend a little bit less, but the consumer is not paying back their debt less.
But are you upping your metrics, and are the lenders getting pickier about who they're giving money to?
So the lenders in generality has been much more picky to
which
the
is
people,
maybe why there's
which
the
is
default,
part of the things that the level of population that is now getting a loan are population that actually could afford it.
So then there are still people who would like to get a loan who can't get a loan.
100%, and this is the biggest thing that we are trying to solve. As we are coming to these lenders, we are trying to help them increase as much as possible to the people that actually should definitely get a loan.
Right, but you don't want to loan money to someone who isn't going to pay it back.
100%.
I mean, and you don't want to increase debt on somebody who's not financially responsible.
Right.
Correct.
That would be a disservice to the consumer. I wonder what an interest rate cut would mean to you. I mean, if the Fed cuts 50 basis points September 18th, does that mean anything for your business?
Definitely it does. So I think with the rates that will start to hopefully go down, and you spoke about the September, but maybe the September is only a start of something that could be a little bit bigger, right? Yeah. But let's look on it more on a year over year. Let's assume a year next year, a year from today, rates are going to be 1 and 1.5% lower. That is directly going to the pockets of the people. So the ability for that to means that investors will require 1.5% less return, and therefore they will charge the consumers 1.5% less. So more money is staying in the pocket of the consumers.
Always good. You must see so much data. What's the average rate on these loans?
So the average rate,
or what's the range?
So the range, let's talk about the range, could be in between a 12 to a 20%, and in a context that's always shy from the credit card rates of the 23, 25, etc., right? So we are talking about lower rates, which usually are a better way to have that debt rather than using your credit card. So why people like so much the buy now,
Not if
pay
it's
later.
20% is pretty rough.
It's still
No,
rough,
it's better than
but
credit card
better than
debt.
credit cards. It's
Right?
everything
You're
relative.
looking at mortgages at 7 or 8,
which is
auto
already high.
loans at 11 or 12,
Yeah.
Exactly.
credit
But
cards
But you're
at
saying
24,
some of the
25.
loans that they give
Exactly.
can go up to 20%.
Up to 20%, but you have lower. You have a 12, and you have a 14, and you have others.
What's the majority of loans? And just got about 15 seconds.
the
terms of the rate?
majority of loan in terms of
rates.
so 15, 16, that's
Yeah.
the numbers. And if you think about it, a lot of it is debt consolidation. A lot of it is some relief to the consumer that like maybe have too much debt on his credit card at a 25% that
Right.
he's trying to
And
reduce.
so he goes to SoFi, he
Yeah.
consolidates
SoFi,
his debt.
consolidate, and in some places where SoFi cannot give him the loan,
Yeah.
Pagaya is behind SoFi making sure it's going to work.
Very cool stuff. Gal, thank you so much. Really appreciate it. Gal Krubiner, he is co-founder and CEO of Pagaya Technologies, joining us here on Bloomberg Businessweek.
You're listening to the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, we got about 19 minutes left in today's trading session here on this Friday. Yeah.
Can't come fast enough.
I know. You make me feel so warm and fuzzy when you say that.
I mean, I love being here with you. I absolutely have enjoyed the hell out of this week.
It's been a long day, though, for you. A long week.
It's every day is a long day, and I just got a message from my mom that says maybe I have to be the nanny for my brother's kid tonight. So
This has not been your day today. I'm just going to say. Well, let's hope Mom gets in. Right now, though, we do want to talk a little bit about the trade, wrap up the week. With us is Miguel Sosa, head of market research and strategy over at Bluerock. They've got $18 billion in assets under management, joining us from San Diego, California. Do you have tornado warnings by you right now? Because we do by us.
Carol, no, we're in the clear for now. Thank goodness.
San Diego's going to be okay.
San Diego's going to be okay.
And the market looks like it's going to be okay, right? I mean, the market looks, I keep thinking we freaked out because of a carry trade that was maybe bigger than anyone expected, and it looked like it was going to get unwound too quick, plus a weaker labor market that maybe was weaker than we didn't expect. Or weaker than we expected, sorry. Now those things have, to some extent, cleared out, right? And we've gotten this big correction, and earnings look great. So doesn't it make sense that we end the week in the green?
Yes, I think that's correct. So specifically for us, I think it's been an eventful July, as you alluded to. Both inflation is down and unemployment is starting to moderate in the sense that it's starting to tick up. So the Fed is recognizing its dual mandate and bringing down inflation as well as not tipping the economy over into a recession. So yes, I think there's a lot to look forward to and hopes and prospects here for a soft landing.
All right. Well, so having said that, after going through a week like we have, and things certainly feel a lot calmer this week, or today, I should say, but we're getting ready for a week where we get, more reads on the economy, inflation prints, and so on. Anything that you've changed dramatically in your strategy or with some of your clients?
So for us, what we've seen is really what was impacted our firm the most is given our relative focus into private real estate has been the pivot around the communication around the Fed funds rate. And so if you think back even a month ago, it was still a higher for longer message that was being communicated by the Fed. The inflation print for June came out, around July 11th. Publicly traded REITs rallied given that we had hit the 3.0 mark for inflation. And so that's when the market started to interpret a higher likelihood for Fed rate cuts this year versus potentially tipping over into next year. And for us, that's relevant because interest rates are related to what's known as real estate cap rates, which are influenced by interest rates. So as cap rates go up, valuations within real estate go down, similar to how bonds work with interest rate. And so what we're seeing is steadier or more stabilized cap rate environment, which should put a bottom to the private real estate drawdown that we've experienced in the last 2 years.
You're obviously not day trading private credit or private real estate. And yet I imagine the volatility in rates must be a little bit troublesome to you. How do you deal with these kind of, 10, 20, 30 basis point swings in 2-year yields?
Yes. So recently, in the last week or so, it has been a little bit of a wilder ride. But it doesn't, to your point, Matt, it doesn't really affect us in our long-term conviction in our strategies, whether it's private credit or private real estate. What matters more is the tendency over, say, a given quarter. And so in our view, it's more so, in other words, the expectation of where interest rates will be 6 months from now to 18 months from now, and what the market expectations are for those interest rates, because it influences, for example, the value of any private credit that we may hold, or it signifies a benefit or a headwind for refinancing private real estate that we may hold. So in our view, that higher for longer has been much more attenuated. And so despite the volatility that we've seen in the short-term basis, we're optimistic that overall it's going to be a more moderate interest rate environment, which should provide a gentle boost behind us, or a moderate tailwind for private real estate investors.
I imagine that you're in the better areas of real estate. So medical offices, student housing, the good stuff, as they say. What do the prices look like these days? Because in commercial real estate, for a long time, and I guess still, there's a big gap between the bid and the ask.
Yes, that's right. And exactly. We like the sectors that continue to have low vacancy rates and significant growth of what's known as net operating income. And so we like the specialty sector, which includes some of those sectors that you mentioned: life sciences, real estate, medical office, student housing, single family rental. We also like, more importantly, the industrial sector that continues to be a very robust sector, very low vacancy rates. When leases expire and are re-signed, they are re-signed at significantly higher rates than they were previously. And we like the multifamily sector as well. What's curious about the current environment, call it the last 2 years, is that the income that real estate is generating is up significantly. It's growing faster than it has in the long term, but valuations are still down. And so, in other words, for a given property, say an industrial warehouse, it's generating more income than it was generating 4 years ago, but the valuation is down 10 to 15%, maybe a little bit more, really dependent on the quality and the location. So it's presenting this attractive buy opportunity, because now that we have more clarity on where interest rates are going to go, then we have a stronger expectation, a higher conviction that valuations will start to move upwards.
Hey, listen, just got 40 seconds left here. So maybe clarity in terms of valuations, but what about clarity in terms of the economy, or clarity in terms of interest rates, excuse me. But what about clarity in terms of whether or not we see a more significant, potentially economic slowdown? And just got about 30 seconds.
Yeah, sure. So briefly, that's always a risk, right? And I think the Fed is still navigating the soft landing. I think the next months will be key. In September, strong expectation that there'll be a rate cut. The market has already assimilated some of the information, has moderated some of the anxiety that it had over the first part of this week. So we think there's higher likelihood that we will stick the landing, as they say in the Olympics.
Anyway, you still got to go to the doctor. Kid in college still has to have a dorm, right? You still need the data center open for your phone.
And a lot of colleges need off-campus housing. Miguel Sosa, thank you so much. Head of Market Research and Strategy at Bluerock, joining us.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.